Welcome everyone to our Aon Insights Masterclass, The Changing Tide of the D&O Market. My name is Eden Fletcher and I lead Aon's financial lines practice in Australia, and we're delighted to have you join us for today's session. Certainly the challenges associated with the D&O market are well known, and whilst conditions do remain challenging, the market for Australian clients is pleasingly starting to show signs of a more stable outlook. Over the course of the year, we've seen positive developments in the risk landscape with amendments to Australia's continuous disclosure laws, and following very material profitability concerns, there's been considerable growth in the D&O premium pool for Australia, which is now arguably reaching sustainable levels relative to the overarching, albeit evolving, claims environment. Most insurers have already implemented their key remediation strategies, and we're starting to see signs of local underwriters being vested with greater autonomy and, in some instances, positioned to provide greater flexibility in their underwriting approach. And after several years of contracting D&O capacity, new insurance markets with no legacy claims portfolio are starting to emerge, which represents a distinct opportunity to disrupt the current market cycle. So what does this inflection point really mean for clients, and what levers are available to better capitalise on current market conditions? To discuss these points, I'm very pleased to be joined today by two of our leading D&O experts, Mary Catherine Thomas and Paul Smith. Mary Catherine is a client director responsible for the development, structure and placement of complex financial lines insurance programs for Australia's global corporate clients for Aon. Prior to joining Aon, Mary Catherine spent 15 years working with global insurers and brings an underwriting lens to the way she works with and advises clients. Paul Smith is a placement director, primarily focused on D&O insurance for Aon's global and corporate clients. Paul has 30 years' experience in the area of D&O and has worked with a significant number of Australia's largest organisations and their boards. So after 3 to 4 renewal cycles of market-dictated outcomes, how can clients proactively manage their D&O program and ultimately take back control? Reflected on this slide is a traditional renewal timeline, which we recommend encompasses a period of not less than 6 months. Certainly the core ingredients continue to include the traditional positive differentiation of an organisation's risk profile in conjunction with a well-executed insurer management plan. However, as reflected on this slide, the traditional strategies need to be augmented and optimised to encompass a review of an organisation's evolving risk profile, and in particular the linkage between residual risk and D&O causation, a review of an organisation's risk tolerance and how this might lend itself to alternative risk financing considerations, stronger board engagement at the outset to ensure that individual director sentiment is built into the strategic direction and procurement of the D&O program, and utilisation of data and analytics to interrogate program pricing and inform key decisions such as policy limits, panel of insurers, options and disruption strategies. So with that in mind, Paul, I might firstly ask you to comment on the current dynamic as it applies to ASX-listed organisations. What is really going on from a market perspective, and what has been the experience with boards over the course of 2021?
Yeah, you've touched on some interesting points there. I might expand a little bit further there, Eden. So if we think about the market, obviously there's two sides to this conversation. There's both the insurer and the buyer, so the audience we're talking to today. If I first look at the insurance market side of the equation, it's fair to say that directors and officers insurances from 2014 to 2020 was by far and out the most unprofitable class of insurance for insurers. And unfortunately for insurers, given the long-tail nature of directors and officers insurance, it'll be 6-7 years before that period is cleaned off their ledger. So for a long time, they're going to be reminded of the really underperforming class of business that D&O has been. But let's talk a little bit more about and expand on some of your points about cause and effect. So what's driven this underperformance or this lack of profitability? Well, the main drivers have been shareholder security class actions. Now, for some of you on the call today, of course, as private organisations, this has no relevance. But the other flip side of this coin has been the regulatory actions. So if you think about things like the Hayne Royal Commission, one insurer shared with us just for their representation costs for their clients, that event cost them $84 million. Now, of course, that's flowed on to many other subsequent criminal and civil actions and shareholder actions and product mis-selling actions against those organisations that were front and centre of the Hayne Royal Commission. But we think about shareholder security class actions on a positive note. In the last 12 months, we've seen 8 class actions filed versus 12 the prior year. But with an average settlement cost of $50 million, you can see how quickly that can erode the premium pool. Now, on the premium pool side of things, we've had constant uplift of premium for at least 3 or 4 years now, where we think the premium pool is going to land at about $900 to $1 billion Australian this year. Now, think about that again in context. It was only 3 or 4 years ago where that premium pool was $300 million. Quite a significant and sharp increase. So one of the other factors we're really noting at the moment in terms of insurer behaviour is this distinction between preferred and non-preferred business. And we'll talk through this a little bit more as we move into some other slides. But essentially, for preferred business, there still seems to be a strong appetite for insurers. That's not to say that they're sharply chasing that business, that's overly aggressively competing for it. But there's certainly much more tolerance and much more appetite for that part of the portfolio, which is quite distinct from the non-preferred part of our portfolio. So what's this doing for our buyers? Well, it's been an interesting journey, I think, for the 3 or 4 years up to this last 12 months. Our clients rode the premium wave up. So they maintain the coverage, they maintain their sums insured, and they chase the premium up. But we've noticed considerably a major shift in the swing this year. And the slide you're looking at now is just a small caption of that event. What we have seen for our larger clients, particularly if we move into the ASX 100, is a significant reduction in the cover they're buying off their insurers, but also the sum insured, the amount of capital they're purchasing from the marketplace. So we're seeing this shift dramatically change, which again is quite a change from prior years. The other thing that we're really noticing as we've come into Q4 is a moderating of the market conditions. So we're seeing a softening of insurers chasing premium increases. And in some occasions, we're actually seeing competition come back in, particularly if we're seeing clients reducing their sum insured. And we now have some insurers who have a end-of-year budget now chasing that budget as premium is starting to come off. And the last note there, Eden, I just close with is, what does 22 and 23 or 2022 and 23 hold for us and for our clients? I think it's fair to say that we'll see a more competitive market for preferred business next year. And I think as we get into the back end of 2022, it's likely as insurers start to chase down price on the better risks, they'll see the non-preferred risks at a higher price point almost start to look attractive. And I think we'll start to see some more competition return for that part of the portfolio, supported by new capital. So I think that there is some positive, really positive shoots ahead, Eden. So thank you.
Thanks very much, Paul. Some really, really interesting comments around, obviously, the publicly listed market. And so, Mary Catherine, I guess with Paul's comments in mind, could you perhaps provide the non-listed company context?
Yeah, absolutely. So we're quite often asked by private companies, why am I paying for the claims of listed organisations? So I'll try and help put a little bit of context around that for you today. I think the first point to note is that insurers look at Dino as a pool. So both listed and private companies, including management liability package products, all go into one premium pool for insurance carriers. And generally, across the board, they're looking to increase rate from private through to listed organisations. Is that fair? Well, if we actually look at the risks that are attaching to private organisations, there are some emerging risks and trends starting to come through. So I've got 5 I'll call out for you today, just to give that a little bit of sense and flavour. The first one is regulatory, which Paul touched on, the Hayne Royal Commission. There's been several other Royal Commissions that have taken place over the past few years. What that's meant is ASIC, APRA, ACCC, they're all empowered and encouraged to look into companies more closely, to commence investigations and really to ensure that there's good governance across their particular sector and client base. So that's definitely an area of focus for insurers. A couple of emerging trends, the first one being employment practices liability. So the big topic at the moment is to mandate vaccination or not. And I think we're very much at the early stages of what the right answer there is. And certainly insurers are concerned that they will start to see an emergence of class actions where organisations have chosen to take a certain path. Also flowing from COVID is the potential for class actions of the back of not providing safe workplaces. So be that for discrimination of people that have been let down versus those that are remaining, say unsafe work home environments, and also frontline workers and the exposure that they're getting to the general public. So there's a range of different concerns that the insurers have off the back of COVID itself. Moving outside of employment practices, we've got ESG, so relevant to both private and listed organisations. And there's been several press articles over the last few weeks around ESG. So lenders, shareholders, customers are actually questioning organisations around their ESG strategy, and not just ensuring that you've got one in place, but actually what you're saying you're doing is in fact what you're actually implementing. So that is a really big emerging market and emerging concern for D&O insurers. Then finally, insolvency, whilst the numbers have been down over the past, the insolvency case numbers have been down over the past 18 months, thanks to some of the safe harbour provisions that have come through as part of the COVID environment that we're working in. As they start to come off and the cost of debt rises, there is a concern that we will start to see an uptick in insolvency. And the last one I'll call out for you is workplace health and safety. So we have seen several states go down the corporate manslaughter path, and whilst fines and penalties aren't insurable, there's significant increase in costs in actually defending those matters. We're seeing that the actual time taken to reach a conclusion is shortening, and therefore D&O insurance carriers are there from the front end to help guide clients through those particular instances. So several risks attaching to the private space, which are increasing insurers' concern around the rates being charged. I'll now just defer to the chart that's on the slide here to say what is happening with rates. And what the two lines here are trying to pick to you is the average and the median. And to pick out on a comment Paul made earlier around the non-preferred risks are becoming more and more challenging, that's reflected in the light blue average line there. So we can see that is being skewed by those non-preferred risks versus the median purple line where it's a much smoother increase. So overall, we're seeing that private D&O is still increasing anywhere from sort of 15 to 25%, which is actually not dissimilar to the publicly listed increase of 18% across our portfolio for the year to date. So the increases are similar, but pleasingly for private organisations, the one positive you can take away is you're paying nowhere near what a listed organisation would. So we're showing an average and a median premium here of around sort of that 4K per mil mark. For a listed organisation, a small listed organisation, you'd be paying $50,000 per $1 million of cover. So you're well and truly still being showing favouritism from the insurers being a private organisation, even though you are seeing some uptick in premium as a result of those heightened risks. And we just want to start to move into some tools that we're actually using when setting the strategy with clients. So the first one I'm just going to touch on is the board survey. So the board survey is something that we've introduced this year, and it can be used for private and public organisations. And what it's aiming to do is to provide insurance managers with some insights as to the way the board's thinking. That way, those insights can be taken and used when ultimately setting renewal strategies. So why has it become more important to look at this? What we're seeing is a real divergence between company views versus emotional purchasing views of the board itself. So as insurance costs continue to rise, generally the company is starting to make a harder stance around what they're prepared to spend on insurance, and therefore what their risk tolerance is to hold to the balance sheet. But those directors are sitting there saying, I still want that personal protection. I don't want to give up my limit. The board survey is a good tool where an insurance manager may not have full access to all of the board members, or where you might have one or two board members that dominate a conversation. So the questions themselves can be tailored to the relevant organisation and what the insurance manager is trying to glean out of the survey. And as you can see on the screen here, what Aon produces is a report for you that actually gives you the statistics and outputs from that confidential survey that goes out to the board members. So to call out an example here, the chart on the left-hand side there talks about the director's views around a class action, the risk to a class action. So on this particular chart, you can see it's moderate to high. So that's an emotional view from a board member. Whereas if we overlay that with the a factual analytical tool, which we're going to touch on later on, the actual probability of a class action for the organisation could be quite low. How do we then manage that between board drivers and concerns versus company expectations? So that's a little bit of food for thought there, and these surveys will become more relevant as we work through some of the further slides. So with that, Eden, I'll hand it back to you.
Thanks very much, Mary Catherine. Some really great insights around how that stronger board engagement can really deliver an optimised outcome. Look, I think certainly the timeline itself is obviously peppered with opportunities to leverage data and analytics to better inform the decision-making process and certainly market engagement. Could you perhaps talk about what this means practically and how this better positions organisations in the current environment?
Yeah, it's increased limit factors. So this is a new addition, or recently new addition to our toolkit, Eden, and it's been quite a useful tool. And I'll talk to this particular example because this is in fact a live example for a client that we picked up this year. But essentially, just to explain what the graph is talking to here is, if you imagine as you're a buyer of insurance, and if you're a big buyer of insurance, and this is based on our ASX 100 portfolio, so they buy significant sums insured. So across the Y or bottom of the graph there, you'll see a sum insured up to $350 million. And on the vertical or the X side of the axis, you'll see a premium based on a per $1 million worth of costs. So if you look to the very left and you see those three colours, you'll see a dark blue line, which represents the client's current Dino position. And for their first $1 million of cover, they're paying somewhere in the order of just under $100,000 per $1 million of cover. For the two lines below that, you'll see this is the database, our ASX 100 database. We'll populate this through. And essentially what it's doing is it's showing what the average and the median cost of that same portfolio for the similar attachment points. So essentially it's a really just a good way for us to make sure at different points on the client's program to understand what's going on, does it make sense, does it need to be targeted, and so on. So let me talk to this one. So in terms of this one, this was used for a client that we picked up this year, more recently, and it was a really good and strategic way to come up with an informed strategy around how we might reposition them and rebuild their narrative in the marketplace. It's fair to say that historically this client had a claim. It had an expectation that was not achieved. In other words, the claim loss was contained within the lower levels of the program, probably in the order of up to about $20 million. But if I draw you back to that slide, and particularly that blue line, you'll note at about the $50 to $60 million attachment, that really noticeable vertical spike. What that's saying is essentially, if the premium at $1 of the sum insured was $100,000, somewhere up the tree of the program, we find that started to stretch up to $110,000, $120,000. So it seemed to us that the incumbent insurers at that attachment point had baked in some loading, some premium expectation of, we are going to pay a claim. Now, of course, again, that wasn't realised. So it gave us an opportunity to rethink the whole narrative around this client, how we took it to market. And the other aspect of this particular tool, which became really useful for us, was to be able to say, use and turn the insurer's own data back upon them. So that median and average rate lines are based upon the insurer's data. So essentially, we drove their own pricing models back upon them. And I must say, when we look back at this client now, if we put in their current position, their renewal position, you would find many of those dark blue lines now sit below the average and median. So it was a really effective tool for us to help build a narrative with a client, to target certain aspects of their program. And it also then enabled us, as I say, to take a very different conversation to the marketplace. So this is becoming a really useful tool for us, Eden. It's as a broker, it's a really delight to use and play with.
So I'm just going to jump in now and talk to you about the Dino Decoder. So this was something that we unveiled at our risk conference last year. Pleased to say it's now been live for some time and clients are really seeing great benefits out of it. So it was something we thought it was worthwhile retouching on this year. So just to put this into context, for private companies listening, this won't be relevant to you directly, but I think you'll still find it of interest. So it is focused around modelling securities class actions from an entity perspective. So just to explain what the model does. So we take your historical share price, including the volatility that may run across it, your market cap, your shareholding profile. So if you have a major shareholder, that's taken into account. And all of those factors are run through a Monte Carlo model. And there's 250,000 simulations that we run through, overlaid with historical Australian class action data. Now, Australian data is the important key here. And the reason for that is we do know that some of our peers utilise US data, but we also know that the actual profile of class actions in the US are quite different to those here in Australia. They're more frequent, they settle quicker, and the quantums aren't necessarily as large. So with that, we feel it's really important to focus in on Australian class actions and the history that we can pull from those when ultimately helping clients understand the return period and likelihood of a class action. So what the chart's showing you on the right-hand side here is for this particular client, their peer group has an average return period of 210 years. So what does that mean? It means that the likelihood of a class action occurring for this peer group is 1 in every 210 years. And when that occurs, the loss is estimated to be $26 million. So if I take that and go back to my board survey comment earlier, we've got a very emotional board who's saying they feel their risk to a class action is quite high or moderately high based on the previous chart. Yet the actual actuarial independent factual modelling is telling us it's a 1 in 210 year event. So what does that mean? It means that the client can actually, so the insurance manager can take this model back to the board and try to give the board some comfort around their probability and quantum of a class action. Now, that may or may not change the emotional view from the board members, but it should give them some more comfort in the organisation itself, holding some of this risk to balance sheet. We can then also say, okay, if it's a 210-year event and property insurance, for example, is purchased to a 1 in 100-year event, then perhaps we're better off to put our insurance spend into the property program than what we are buying side C securities class action cover. So this model is being used by boards and insurance managers to validate some of the decisions that they're making at a board level around insurance purchasing. And if we go back to Paul's original slide which showed the movement and change in programs that listed organisations are moving, we did see a significant reduction in side C limits, and in a lot of cases has been validated through this particular model. The other benefit the model has is we can actually use it to readjust the insurer's viewpoints. Now, it's going to be a little bit harder for some of your core D&O carriers that have been in the market. Premium to cover. But for new green shoot capacity, of which there's a good dozen of them over in London, which don't have that tail, we can actually go in for an account like this, and as opposed to buying to as opposed to the insurers charging a 1 in 10 year event, we can actually validate and say, well, based on our modelling for this particular account, you should be charging on a 1 in 210 year event. So therefore, we're expecting the pricing should be squeezed down. So two benefits to this one. One, it helps inform decisions and give an independent validation model to the insurance manager and the board. And it also helps us in the marketplace to be able to try and squeeze and reduce down pricing.
Thanks very much, MC. I think certainly some great insights there around how we can obviously potentially leverage that new capacity that you talked about, but certainly assisting boards to recalibrate the way they purchase D&O insurance rather than obviously specifically relying on peer benchmarking data. So, Paul, with that in mind, maybe we could turn to you to maybe close out with what we're doing around Insurer Analytics in particular.
Yeah, it's an interesting one, Eden, that a lot of what we've talked about so far in this data analytics piece has been far more fact-based or objective-based. And what I'm about to show and talk through is more around some subjective insights that we pull together. So it's about how we feel as brokers. So we as a broking group, some 50,000 of us across the Aon network, are called upon twice a year to respond to a survey. And that survey will categorise based on the area that we practice our business in. So for myself, that's predominantly in the larger end, directors and office insurance in Australia. So we pull this data together, as say, twice a year, and we're able to map out this information. And what it does, in a very simplistic terms here, is it scores insurers. So it'll score them on their performance, a bit like a Net Promoter Scorecard. And it'll score them out of 0 to 10. And clearly 10 being the preferred position. Now, if you look at this screen in front of you at the moment, what it's showing is a purple dot. So for a particular client conversation, we showed them where their insurer sat, their primary insurer sat relative to 4 of the key peers for that same insurer. And you can see on various different metrics there, that pink dot was either above the average line for the group that was being considered, or it was below the average line. So it was a really useful tool to sort of draw some insights to weigh up what the things that we thought were important for the client and what they thought was important from an insurer, and really see whether that insurer was delivering on the metrics that were most valuable to our client. Just a good example, we had a recent case. It was a very different looking slide to this one, and I thought it was really powerful. We picked up another client where they were really frustrated by a view that their insurer didn't understand their business model. They had a business model based on economies of scale, one where growth of their business was through acquisition. It was a constant flow of more acquisitions on a regular basis. And yet, on one side of this page, it looked, a pretty good outcome. On the price point, less so for the client. So the client was saying, well, hang on, our price keeps going up. We're expecting some flexibility on price here. And they kept focusing in on the price bit and saying that they're just not delivering for us, that the market's not delivering. And we actually took them back to the left-hand side here. And what we said was, if you look back at that average and where that pink dot is sitting above the average line at the moment, in this particular insurer's case, it sat well below that average. And why was that so? Well, this in particular insurer is a big cumbersome beast, but they just weren't flexible day to day. So their frustrations in reality weren't borne by the price piece. It was borne by this inflexibility around a solution to fit and model similar to their client. So it was an interesting way how which we reposition again the client around, well, look, what do we need to do in the market? It seems to us very clearly that all our brokers are telling us that this is not the right insurer for you. And we then started a reposition based on the pool of other insurers, what we thought was the right client for, or sort of insurer for them. So I guess where this all leads to, Eden, is really a view of moving beyond a traditional broker where we would simply go to market and scattergun and hopefully come up with a good outcome and, build up everybody based on the power that is Aon. But the whole shift now is really about moving from a predictive world to now one of creating a world for our customers and our clients. And this is really what this is really underpinning. All this data and the analytics we're talking about really gives us a baseline to underpin the market. So we don't have to worry about what the market's doing. We get to go into the market and not be a taker anymore, but be a market maker. And I think that's a massive shift in the way in which we engage today to where I was engaging even as little as 5 years ago. So I'm really excited about it. It gives me lots of opportunities to talk to clients in a very different framework today.
Wonderful. Thanks very much, Paul. And I think certainly, as organisations reinterrogate the D&O purchase, I think it's certainly appropriate, as you talked about, to certainly reinterrogate an insurer's full value proposition. So certainly some great tools there for the benefit of our clients. So certainly we're at the end of the session today, and I wanted to thank our panellists for joining and sharing their insights. As I noted in the opening of the session, our goal was to share some of the key levers available to our clients in order to proactively manage their D&O program and ultimately reclaim control after several years of market-dictated outcomes. We're certainly on the crest of a wave, and some of the techniques Mary Catherine and Paul have talked about today are providing tangible value to those Aon clients who have already adopted these strategies. It is certainly our view that these are critical enablers to take back control and disrupt what has been an incredibly difficult D&O marketplace. So thank you very much for joining us today. It certainly has been our pleasure to engage in this conversation, and we look forward to engaging further on this very important topic. Thank you.